Welcome to the Professor Lending Institute, where we make sense of housing economics and the home buying process. I'm Jordan Steffaniak, president of Professor Lending, licensed loan originator, and your home buying professor. In today's episode, I'm going to explain the differences between a 401k loan and a HELOC, or a HELoan and a cash-out refinance. But primarily, we're going to focus on the 401k loan versus the HELOC. So let's go ahead and get down to business. The reason I thought about this is I've compared and contrasted personal loans, credit cards, HELOCs, and different things like that in the past in another video. So if you want to click that link, it should be somewhere around here. Click wherever it is, it should show up if you want to check that out. But in this case, I had a conversation with a couple the other night where we were discussing some of their goals, their financial goals. They have windows they need to replace in their house. They need to replace the siding on their house. And so they were thinking, how do I best achieve this goal? And based on the knowledge that they had, they thought the 401k loan was the obvious solution to their problem or their need, their goal. But they hadn't considered a HELOC or a refinance. Well, they had considered a refinance, but they had a 3% mortgage rate. So it was like, well, obviously, I don't want to get rid of that. Mortgage rates are at 7% today, so I'm going to lose a bunch of money. So if I do a 401k loan, then that's saved me a ton of money. What they didn't think about is the home equity line of credit. And they didn't think about all the pros and cons of a 401k loan versus something like a HELOC. So let me go ahead and just walk you through some of these diagnostic tools to think about what's best for you. Now, my suggestion is, number one, no two situations are alike. They're all like snowflakes. They're all unique in their own sense. There's not a one-size-fits-all solution. So you need to look through all these pros and cons of everything. Explore your own situation, but my advice is always to talk to a licensed loan originator like me who can actually help guide you and understand your process to educate you on what's best for your situation. Do you need a really low monthly payment? Do you want to minimize the amount of interest that you're going to pay over a certain period of term? Do you have plans to move? Do you have other goals? Do you have other upcoming purchases? All these questions need to be taken into account to be able to make a wise decision. So let's talk 401k loan. So some of the pros on the 401k loan, let's say you've got 100,000 in your 401k, a million in your 401k, whatever. The benefit of this is there's no credit check on a 401k loan. So you take it out, it's not being reported to the credit agencies, that's not getting dinged on your credit. So this is especially helpful especially if you're on the lower end of credit and you have a foreseeable purchase in the future that you need to make. That's not going to ding your credit. So that's nice. And you're not actually paying interest to anyone else. You're not paying on a normal traditional loan. If there's a 6% interest rate, a 10% interest rate, whatever it is, that interest money is going to the lender. In this case, the 401k loan, that money is going back to yourself. So if it's a 7% interest rate or a 9% interest rate, whatever it is, that money is getting paid back into your account. So you're not actually paying any interest. It's your money. So it goes right back to you. So those are the two big valuable things, in my opinion, on the 401k loan. The downsides of the 401k loan, there's a couple of pieces here that you should take into account. Number one, there's a cap on them. So you can't do more than $50,000 and you can't do more than 50% of whatever is in your account. So if you had $75,000 in your account, you can't do $50,000. You can only do 50% of that. Or if you had $300,000 in your account, you can't do 50%. You can't do 150K. You can only do 50K. So depending on your needs, this may be a non-starter. Maybe if you need to remodel your kitchen and get a new roof and whatever else, it ends up costing you $80,000, $90,000, $100,000, and K loan just isn't going to cut it. It's not going to give you enough cash. However, if you have some credit card debt or something you wanted to consolidate and get out of that high interest rate, maybe that is sufficient funds to help you. But you got to know your goals and your needs. The other thing is, if you were to switch jobs, get a new job somewhere else, or to lose your job, you're going to owe that full amount on whatever's left on the 401k loan very quickly. It's basically a balloon payment. You'll have a little bit of leeway, but they're going to require full payment back on this. So you've got to think about that. If you potentially switch jobs, if you took out $50,000 and you switch jobs in 6 months, well, you've got a lump sum that's now due. So you got to keep that in mind. You have to actually keep that same job if you don't want to have a balloon payment coming up. And if you don't make the payment back, then you're subject to, obviously, 10% early withdrawal fees. It's going to be taxed as actual income on your tax returns. So it's going to end up, you're going to be paying a significant amount of interest on what was supposed to be a no interest type of loan. And then, of course, the big thing that people don't think about with the 401k loans is the lost opportunity growth. So when you take out money of your 401k, that means less money is being able to grow in that account. If you look at all the charts, like what happens if I start putting $50 in when I'm 18 versus start putting $50 in once I'm 35? The growth potential is significantly less because the more that's in there, the more that it grows over time. So if you take out $50,000, you're losing that growth opportunity. And so you got to think about that. There's a difference here that you got to be making sure. So let's give you an example. If you're 30 years old, let's say you're 35-ish years away from retirement, let's say you took out $50,000 and the interest rate was 7%. You're going to probably, based on normal market conditions and normal market returns, you're going to lose potentially up to $70,000 in traditional 401k growth over the lifetime of that. With a HELOC or something else, if it's the same exact 5-year term with that same $50,000, that's going to be like $12,000 in interest. So $67,000 versus $12,000, you just lost $55,000 by picking the 401k loan. Okay. And the same thing, if it were an 8% interest rate, you're going to lose a little bit less because you're putting more money in up front over each paycheck, but you're still going to lose $35,000 ish. And it could be more, it could be a little bit less. You don't know, just based on market conditions and all other sort of things. But you're going to lose a lot of money. If you were 40 years old and let's say you're 25 years away from retirement, $50,000 at 7%, you're going to lose $26,000 over that opportunity. And then if it's 8%, you're putting 8% back in, you're going to lose about like $15,000. So it ends up getting pretty close there in these scenarios, but you're still losing a lot of money and opportunity in that 401k. So that's something you really got to think about, is if I take this money out, how much am I actually going to lose? You're not going to see that in any bottom line. You're going to have to actually do some math and talk to an expert, a financial expert who can kind of like extrapolate, like, here's what our growth potential would be with this money in the bank versus without it in the 401k. What happens? Where's that gap? What am I losing over my retirement? So you don't want to drain yourself of a lot of a financial future when you could have done another option. So the option that I bring up now in comparison is like the HELOC. And the reason I do that is because a lot of people who want to take money out and they're looking at a 401k loan are doing that because they don't want to do a cash out refinance because they have a 3% rate on their house. They don't want to lose that really great rate in that payment. I get that. And we'll talk about cash out in a second as an opportunity. But if that's you, the HELOC is actually a really, really great solution and option. A couple of reasons why. Actually, you're not going to, the interest paid, like I said, the difference between a 401k loan versus the HELOC, you're going to actually pay a lot less or lose a lot less in interest. Where the total interest over a 5-year term on a HELOC, $12-ish thousand for that $50,000 you're getting back. The other benefit of the HELOC is you can go way above $50,000. You got a lot of equity in your house and you got a large project or a large budgetary expense, you can do $100,000, $150,000. You could do more money on the HELOC. There's wide open window up to typically 85-ish% of the loan to value on the house. You also are going to have that same sort of low rate on there, much lower rate than personal loans and credit cards and all those other things, extremely competitive. There's also the benefit that if you wanted a really low payment, you could extrapolate a HELOC to a 30-year term. So if a low monthly payment is really important to you, you can make that a reality where you can't on a 401k loan. Usually the term's going to be 2, 3, 4, 5 years. HELOCs, 5, 10, 15, 20, 30 years. So you can get that payment really low if you need to. Obviously, if you did a 30-year term and you actually let it last for the whole 30 years, you're going to pay a lot more in interest. But the reality is most of you are probably not going to be in that house for another 30 years. You're going to move, you're going to refinance and consolidate the debt or do something to where that interest isn't going to impact you. Remember, the average life of a loan of a mortgage is 7 years. It's probably getting less now. And so you got to think in smaller chunks. It's a 30-year term, but you're probably only going to be in that loan for 5 to 7 years-ish. And so that should influence how you do some calculations, right? The other thing about a HELOC that's nice is that the Tax Cuts and Job Acts of 2017 allows homeowners to deduct the interest paid if on a home equity line of credit if it's used to buy, build, or substantially improve your residence. So talk to a CPA, licensed expert on that to make sure that you qualify for that. But that is something to keep in mind with a HELOC that you don't have the advantage of in a 401k. Now, if you had a 6 or 7% mortgage rate on your house already, my suggestion would be to do a cash out refinance. Why? Because you're going to get a little bit lower rate, and the growth in the loan amount on what's already large, just making it a little bit larger, is actually going to save you a large chunk of interest, and that monthly payment is going to go up much smaller. So of the options, the cash out refinance is king. And I think it will always remain to be king. But if you already have a low interest rate, you have to do the math here. You have to be able to do the math to figure out which one is best for me. You plug them all in and you look and compare these different things and you try to get them as close as possible together, apples to apples. And then you can determine what's my monthly payment, because that's an important thing. The other thing is, how much interest am I going to be paying over a 3-year period, over a 5-year period, over a 15-year period, etc. And then that can help you make a decision. So my advice is typically, depending on where you're at, if you're like right next to retire, if you're 60 years old, a 401k loan's great. It's not going to impact your 401k very long because you're going to retire and start drawing on it anyway. So the growth opportunity is not there. If you're 30 years old, 40 years old, even 50 years old, a 401k loan is an okay option, but there are better alternatives that you should be exploring and making sure that you have all the information possible. You want to be as educated as possible to make the most responsible decision for you and your family. You don't want to lose out on money that you could have been able to give to your children to go to college. You don't want to lose out on money that you could have saved to give to your grandchildren or whatever it is. You don't want to lose out on these wealth building opportunities because, like I said, no two situations are alike. You can Google a lot and it's going to give you some decent advice, but it's not going to give you specific advice for your situation. So, based on what I've discussed here, my advice to you is, if you're considering this, talk to somebody like me. If you want to talk to me, you can email me, you can direct message me, you can comment, and if this is on YouTube, you're watching it here, you can drop a comment below, and I'm happy to reply to you and talk to you and learn more about your situation and hopefully help educate you to be able to make the right choice for you. Because that's what I'm all about. Here at Professor Lending, we want to make sure you're educated and empowered to make the best decision for you and your family. And that may not include me. That may not include us. And that's okay. We want to make sure that you are maximizing the return on your investment, return on your assets, and make sure that you are avoiding bad debt and taking on the good, right kind of debt to be able to set you up for a better future as well as for your children. So that's what I've got today. Check out the other videos that you, if you're interested, make sure to subscribe to the channel and like the video if you enjoyed it and if this was helpful in any sense. And then do drop a comment if you think this was useful. Let me know what you think. Do you think a 401k loan's better? Do you think the HELOC's better? Do you think the cash out's better? Or do you think something else is better? Drop a comment. I'd love to hear your thoughts, and I appreciate you all for tuning in, and we will keep educating you in the future. Hopefully, right?